Joining me now, David Owen, Chief Economist at Jefferies International. Good to see you again, David. So, first of all, what did you make of that indication of a rate rise? Did it catch you by surprise?
I think he knew exactly what he was going to be doing. So,
yeah.
And it's made the situation actually much worse, and it puts more, I think, pressure on Brussels in terms of, you know, the meetings at the end of this month on 24th, 25th to solve the big problem. Because at the end of the day, this makes it much more likely that Portugal is forced into a bailout situation. And if they do raise interest rates, then Spain could tip back into recession. So I'm not thinking he thinks that, but I think that is the outside risk.
On the flip side, do you think then that could be a good thing? The fact that it does put pressure on European leaders to really come up once and for all for a comprehensive solution. Yeah,
I may have missed it, but I mean, in previous meetings and certainly in Brussels, he's basically said, we've done the M, it's up to you to put the E into EMU. And, you know, what he did yesterday, I think, was saying, right, you know, we could even raise rates at this juncture, even with all the market distress. It's up to you to come up with this big bang solution. But I think in order for them to raise rates next month, things have to calm down the markets. And in fact, things haven't calmed down. In fact, it's made matters worse.
So it's not a certainty then?
No, absolutely not. It's very much conditional on what happens after the 24th, 25th. I have to say there is no inflation, really any inflation problem in the Eurozone. I think they're over-egging it. Of course, they have
but it's
been here
target,
before.
No?
It's above target, but they've been here before. In fact, they've had an average inflation rate above target since '99, really. I mean, for much of the period. And, you know, in that period, for 2.5 years, they had rates on hold at 2%, and inflation on average then was above target.
But could the surge in commodity prices, the sharp rise in oil prices off the back of what's happening in the Middle East and North Africa now make inflation worse?
Well, it's going to make the headline inflation rate worse, that's clear. But in terms of the core rate of inflation, that's running at about 1%. There is no monetary growth. You know, if you go back to the oil price shock of the 2008 period, the money supply then was growing at around 10% year on year. There is no monetary traction. And it's very interesting because in previous rate cycles, when they were raising rates, they justified the rate move on the back of the monetary data. Even Mario Draghi, you know, talks about the strength of bank lending. This is, you know, we're not seeing this at the moment.
You mentioned Mario Draghi, and you said this meeting in Paris, interesting for a number of reasons, off the back of this rate rise indication from TRICHET'S, and I also suppose in the succession race for the ECB too.
Absolutely. I mean, he remains obviously, you know, one of the clear favourites. And it'll just be interesting to see what comes out of the meetings. Also, Axel Weber is in London next week. It'll just be interesting to see what he says, perhaps. I mean, it's all these things, you know, add to the mix. But at the end of the day, it's the meeting at the end of this month, 24th, 25th, which is key.
That's the thing we're really gearing. How difficult is it going to be for them to meet this deadline, European leaders?
Well, firstly, are they going to come up with something which satisfies the market? That's the more difficult thing, and I really don't know. I mean, it's the size of the bailout, it's the interest rate that's charged.
Does the bailout fund have to be expanded?
It has to be expanded. The interest rate that countries pay on it has to be reduced, and obviously there is this argument that the fund should be activated to buy bonds in the secondary market. And all these things are up for discussion and clearly are not popular, particularly in Germany. So it's not clear that they'll come up with the final resolution, but also whether it will actually satisfy markets.
And David, you said that this meeting currently taking place in Paris. We're hearing from David Tweed. He's on the scene. You said it was interesting. What are you watching for from this meeting?
Well, just any statements in terms of, you know, any more clarity about what they may be doing over the course of the next few months. Anything that's said will be interesting. But at the end of the day, you know, I think Trichet said it all yesterday. I mean, he is Mr. Euro, after all. Also, by the way, we have an IMF report published at the middle of this month on Ireland. So there's a long way to go between now and April the 7th, the next time the ECB meet.
Tell me about the risks of a rate rise at this point for those fragile southern European economies.
Well, it's basically pushing Portugal to accept a bailout.
You're saying it's inevitable now?
It's almost inevitable. You can't say,
no.
You can't say, but it is almost inevitable, and they've been quite rationally resisting it, because as soon as you go to the bailout, the situation for your own domestic economy actually gets a lot worse. So that's where Portugal seemingly is going. And the issue is, if they raise rates, Spain is still heavily indebted. Private sector debt in Spain is running at around €2.5 trillion, and most of that feeds off the short rate set by the ECB. So there is a risk here that Spain tips back into recession. I'm not saying it's a big risk, but it's a risk.
There you go. Great to get your thoughts, David Owen. Thanks very much indeed for coming in, Managing Director at Jefferies International.